So follow the bouncing ball. Our first payment here, let's say it's due in January. So we send a January payment of $954.83. That's principal and interest. And then we have a new balance over here. But that's not the only thing we're going to do here in January. We are going to send some extra money towards the principal, and let's see what happens. So let's say we had an extra $1,200 laying around that we wanted to do something with. Well, instead of investing in a mutual fund or something like that, we send it towards paying off our debt. Well, is that a good idea or not? Let's follow the bouncing ball. So in January, we send a check for $954, but we send another check along with that January payment of $1,192.30. So in January, the lender gets two checks from us. The first one is for regular payment. The second check, the $1,192, is prepaying towards principal. Now, how did I come up with that $1,192 and 30 cents figure? I isolated and looked specifically at these four principal amounts. And I'm doing it just for this example, just so you get the concept of it. So those four principal amounts, we're going to prepay, and those add up to $1,192.30. Okay, so the lender gets that all in January, and they apply that. So at the end of January now, we owe down here $198,549. Okay, question for you. Here's your first quiz question. On what line of this repayment schedule will our February payment be applied to? See, under the terms of the loan agreement, we have to pay every month. We owe them $954.83. So in February, we're going to send them $954.83, or else we're going to be charged late fees, and we're going to be out of compliance with paying off this loan. So remember, this payment schedule has 360 lines on it. 30 years, 360 months, 360 lines. So on what line will our February payment be applied to? Well, if you said line 6, February payment, you would be correct. Okay, our February payment will be applied towards line 6. So we send them the February payment. Now, let's stop here and count the money the lender has received. I always kind of got a kick most months of counting the money that came into my division that month. So let's count the money. Well, the lender received our January payment. So they received this principal and this interest amount up here. Then they also received in January $1,192.30. So they received these four principal amounts. Yes, they did. And they received then our February payment. This principal amount and this interest amount down here. Okay, they received all that money. Is that right? Yes, that is correct. So now at the end of February, we owe this amount down here, this $198,256. So my friends, I have a question for you. What happened to these four principal amounts? What happened to that money? Did the lender ever receive that money? No, they did not. They were scheduled to receive it, but we preempted it because we prepaid $1,192. So what happened to that? We call this cancellation of interest. We canceled paying that interest. We canceled $2,657 worth of interest. So what Mark Cuban was talking about, by paying off debt, he gets a better return than any money he could invest in the stock market. Here's what we did. We invested $1,192 towards prepaying debt. We canceled $2,657. And, by the way, that's a little bit more than a 200% return there, which is a guaranteed return because that interest is absolutely canceled, completely canceled, guaranteed. So our return or our benefits a little more than 200% of what we invested, the 1192. Plus, we accelerated the payoff of the loan. We went from line 1 down to line 6. We skipped over 4 months of payments. So the formula is when you prepay part of your principal, you cancel interest and you accelerate the payoff of the loan.